Government rules keep you out of some of the most profitable investments, like the nearly 600% return Blackstone booked on its Celanese deal over the 4 years to 2007, a 55% annual return, or the 4,000% return venture capital investor Peter Thiel booked as one of the first outside investors in Facebook. But the Securities and Exchange Commission locks regular investors out of these profits in an ancient rule going back nearly 100 years. Lawmakers have repeatedly said that they don't want Main Street investors in on the very investments they themselves use. In this video though, I'll show you how to invest in these types of investments just like the rich, even if the government says you can't, along with the 7 stocks to give you access to the world of billionaires. First off though, I gotta send that special shout out to all you out there in the Bowtie Nation. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Back to that rich people investing though, and the Accredited Investor Rule, a part of the Securities Act of 1933 that says only those with at least a minimum of net worth or an income can invest in certain investments like hedge funds, venture capital, and private equity. Accredited investors are those with over $1 million net worth or incomes above $200,000 a year. So yeah, rich people. But this means Main Street investors are locked out of some very solid returns. Private equity, the warm, fuzzy rebranded name for the leveraged buyouts and corporate raiders of the 80s.
Greed, for lack of a better word, is good.
Has easily beaten returns over the last 20 years. Here we see returns on private equity funds with a cumulative return of 11% annualized versus just 6.9% for stocks over the 21 years to 2021. Blackstone alone, the king of PE firms, has returned a 19% annual rate since its founding in 1987. In another study of angel investors, the kinds of deals you find in venture capital investment, where I spent most of my professional career, researchers at Marquette found an annualized rate of return of 27% over the 4-year holding period. Even on more than half the startup investments returning nothing or less than the original investment, these can produce 10, 20, and 30 times your money. And I know everyone hates hedge funds right now, but they do make money. In a study by Bank of America, hedge funds were the only group actively buying stocks last year to benefit from that early bull market. Hedge funds were net buyers of stocks to the tune of $10 billion, while institutionals like pension funds and retail investors were net sellers, hesitating at that bull market and missing out. I'll reveal how you can invest like the rich next, even without the government's permission. But first, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up on average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and then they're going to email you the full report with all 5 stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks, so look for that link below. Back to our main topic though, and folks, Congress has repeatedly come down against Main Street investors, literally saying that it doesn't believe investors are smart enough to understand complex investments. They did it in 1933 with that Accredited Investor Rule. They did it in 2007 when Congressmen Waxman and Kucinich tried to block the IPO for PE firm Blackstone, saying, and I quote here, it wasn't appropriate for unsophisticated investors. But evidently, some of those noble leaders we have in Washington are sophisticated enough, with more than 22 members of the House and Senate investing in private equity alone, and many more in other accredited investments. But there are options for Main Street investors, ways to get around this rule to get some of those returns that the rich enjoy. And first is arguably the best run private equity firm, Blackstone, ticker BX, with its 2.7% dividend and a 17% annualized return since its 2007 IPO. Steve Schwarzman co-founded the firm just months before the 1987 crash, but has built it into an all-in-one powerhouse of alternative assets from real estate to private equity, credit, and hedge funds. And here, if you ever want a detailed look into this world of high finance, check out the book King of Capital by Carey and Morris. It will blow your mind how much Schwartzman has made for his investors. In that same private equity theme, we also have Ares Management, ticker ARES, with its outstanding 28% annualized return since the 2014 IPO. Ares also has that diverse line of businesses from private equity to credit, real estate, and infrastructure, pretty much wherever the company can strike a deal to make money, but also has several other publicly traded companies with different structures, like the BDC, Ares Capital Management, and the REIT, Ares Commercial. Next up, Icon Enterprises, ticker IEP, got hit last year, but still pays a 22% dividend. It's a really interesting way to invest alongside one of the world's greatest raiders. Icon's history is one of the most interesting stories in investing, starting with his first takeover attempt of Tapan in 1978, forcing the sale of the company to Electrolux for a $2.7 million profit. And even his unsuccessful takeovers make money, like the 86 bid for U.S. Steel. He dropped his bid in 91, making $200 million on a $1 billion investment. Now, if you're not a financial history nerd like myself, the usual strategy here is that Icahn buys up the stock or the company's debt for a controlling share. He then pushes management to change management, spin off assets, or just an outright sell of the company. The ability to move billions of dollars around quickly means these company directors take him seriously, and even when he's not able to force that company change, a lot of times the company's just going to pay him a premium on his investment just to make him go away. It's a win-win strategy Icahn has perfected to make billions. Now, IEP is the holding company for Icahn's investments and businesses in energy, industrials, auto parts, real estate, and pharmaceuticals. It owns or has controlling shares in some strong companies here like Pet Boys, CVR Energy, and Vivus. This stock came under a short attack last year on dividend sustainability, but with the dividend cut, it's now a 22% yield and a very good price. A little more mainstream here could be shares of Goldman Sachs, ticker GS, or financial behemoth JP Morgan, ticker JPM. These stocks put you more in traditional banking and finance, but there are still elements of that high finance here, alternative investments that make people rich. We see in Goldman's most recent earnings, the company made more than $8 billion in just 3 months through investment banking, debt, equity underwriting. It also has alternative investment segments that invest in credit, hedge funds, and other deals. Now, these are probably the least risky of the stocks I'll talk about, but also slightly lower returns, with JP Morgan shares producing an 11% annual return since 1985, and Goldman putting out about a 9% return since 1999. We've still got 2 more ETFs to highlight that let you into these rich people worlds of investments, but understand these types of alternative investments should be just a part of your portfolio, maybe as little as 10%, while stocks are still going to be the biggest part there. For that, check out the video here for my complete 2024 investing strategy and the stocks I'm buying. I also wanted to highlight several ETFs that give you access to hedge fund strategies, like the Whole Tactical US ETF, ticker HTUS. The fund uses leveraged futures to create both a long and short position on stocks in the S&P 500, as well as options to create what it calls a risk-hedged exposure. Now, nation, understand that's what traditional hedge funds do, trying to produce a low-risk return through these trading strategies like buying some stocks and selling others. So you're not necessarily expecting the highest returns here, but if the hedge fund manager has done their job, the volatility and the risk in that fund is going to be much lower than the overall market, while it still books solid gains. So while the HTUS has underperformed the broader market, the S&P 500 over the last 5 years, it has also seen relatively milder ups and downs. The fund has produced a 10% annualized return since 2015, which is very respectable on that lower risk. But one thing you do have to watch out for in these smaller alternative asset ETFs is the expense ratio, here which is very high at 0.95% of the fund. Another long-short hedge fund ETF here is the First Trust Long Short Fund, ticker FTLS, producing a very stable 8% annual return since 2014. So again, the fund here is trying to reduce risk by buying some stocks, but also selling others, so it benefits from an up or a down market. You get an idea of how it does this from the fund's page if you look at the price multiple averages for this long and short investments. Now, the long exposure stocks have a lower multiple on average, for example, trading at just 16.9 times on that price to earnings basis, versus the shorted stocks trading for 22.8 times on a PE basis. On the right here, you can also see some of the stocks it's bought and those it's shorted. Judging from the long holding percentages, like 5% of assets in Microsoft and Apple, while less than 1% exposure in shorted stocks like MicroStrategy and Estee Lauder, it is a net long fund. So it's mostly buying stocks, but has covered part of that portfolio with that short strategy, so it can benefit from a down market. So what you get is, again, not necessarily a market-beating return because it has underperformed the S&P 500 over the last few years, but a more stable return. Investors look to these hedge funds to benefit in both up and down markets and not see their money wiped out in a crash. Check out that link below and see the stocks I'm investing in for the next 30 years. My forever stocks up an average 94% last year. Or click on the video to the right for my 2024 investing strategy and the 10 stocks I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.